Hello guys and welcome back to another concepts video. Today we'll be diving into the AMD model, see how accumulation, manipulation and distribution works and how can we implement these concepts in our trading. So let's dive right into it. So what is liquidity? Liquidity can be defined by entities around particular price levels and is essentially the open interest of buyers and sellers in the market. Because there are many buyers and sellers of a highly liquid asset, deals can be completed swiftly and at steady prices. We divide liquidity into two primary categories as we covered in our prior video on external and internal range liquidity concepts. External range liquidity, which consists primarily of liquidity pools at range highs and lows, and internal range liquidity, which consists of fair value imbalances and gaps. We boil down this concept to basically internal range liquidity acting as fuel propelling prices towards external range liquidity. So, after the bias has been identified, making a narrative that describes the most likely scenario for how the prices will go from the current levels to the draw on liquidity comes next. Markets will always move in either an AMD model or a market maker model from one price level to the other. By applying the context of time via session and daily profiles, you can anticipate the timing of transitions between the different stages of an AMD model or a market maker model. Using the structure and order flow and intermediate time frame, we can anticipate how the price will reach the internal or external range liquidity. The highest probability trades are when the higher time frame and the intermediate time frame ideas align with each other. So, what is an AMD model? AMD, also known as accumulation, manipulation, and distribution, are three main phases of a potential price move, which are explained below. The market range is close to the opening price during the accumulation phase, and the institutions build up their positions in this range. Finding regions where the price seems trapped with a horizontal range indicating a possible market expansion will help you identify this accumulation phase. The market is moved in the opposite direction of the anticipated expansion during the manipulation period. When the price absorbs all the opposing liquidity, it goes in the likely direction of the expansion that is coherent with all the time frames, but all the traders are trapped when the price breaks to the unlikely directions of the expansion already. Actual extension of the day or session profile is known as the distribution phase. All the engineered liquidity after the manipulation phase serves as fuel to move towards the price on the higher time frame draw of liquidity. We see time frame alignment is the key to implementing accumulation manipulation distribution models and to translate higher time frame ideas to intermediate and intermediate time frame ideas to the lower time frame for the execution. When we have the bias on the higher time frame, which is the y for our prices, and the intermediate time frame presents how for the prices as to how they will move towards the raw liquidity, it becomes easier to understand the when, which shows when to get in the position on a lower time frame. As we can see here, we have a higher time frame to intermediate to lower time frame. When we move from the monthly to the 12 hour to 1 hour for execution, it is a swing trade. When we have our higher time frame bias on the weekly and 4 hour for the order flow and market structure following, and 15-minute for the execution, we call it a weekly trade. When we have our daily bias followed by the hourly for the confirmation of order flow and liquidity, and the 5-minute for execution, we call it a day trade. And a sessional trade is when we use the 4 hour for the higher time frame bias followed by the 15-minute for the intermediate time frame confirmations and the 1 minute for the execution. It is a sessional trade. To understand if the arrays will hold or not, we need to understand if the consequent encroachment levels of the array, which is nothing but the 50% level of an array. if price closes below the 50% level, the array becomes low probability. The prices are sensitive to the upper half of the bullish array or the inversion level and the lower half of the bullish array or the inversion level. There are two types of AMD models. Here we have the bullish AMD model. So price builds up close to the day's opening price on a bullish day, resulting in a ranging price movement. After that, there is a period of manipulation as seen by a strong sell move above the accumulation range, which manipulates the liquidity and targets any areas for support. As we can see here, we have a ranging price action and accumulation near the price opening of the day. Then we see a manipulation which is usually into a higher time frame or intermediate time frame array, still keeping the higher time frame drawn liquidity intact. Following that manipulation, the price increases in a way that is consistent with the higher time frame bias, the present order flow, and the market structure. And this particular leg is called the distribution leg. After the formation of the day's high and the clearing of the previous highs and liquidity pools, we observe a shift back into the daily range, leaving a wick above the closing, leaving a wick above and closing below the day's high. Then we have the bearish AMD model, where the price builds up close to the day's opening price on a negative day, resulting in a ranging price movement. A fast buy move above the accumulation range, and the liquidity is engineered and resistance in the form of any arrays is targeted, giving the manipulation phase. So here we see some accumulation, some ranging price action near the price opening of the day, and then we see manipulation right into any bearish array on the higher time frame or the intermediate time frame idea, still keeping the draw on liquidity intact towards the lows. And then we see price decreasing in a way that is consistent with the higher time frame bias, the present order flow, and the market structure. This particular leg is called the bearish distribution leg. Following the formation of the day's low and the clearing of previous lows and liquidity pools, we observe a shift back towards the daily range. Here, as we can see, and a wick is left below and the closing above the day's low. Now we move towards some examples for a better explanation of the concepts. So here is an example of the US dollar index on the daily time frame. We will be trying to combine how AMD models work on intermediate time frames while being coherent with the higher time frame ideas. So here we can see clearly that price is bearish because it is respecting all the bearish market structure and following the order flow. As we can see here, we have a bearish daily fair value gap where the price has swept the previous highs, taking the support from the bearish daily fair value gap and good enough resistance for price to close below the 50% level of this fair value gap. This is internal range liquidity where the price has engineered liquidity from here moving towards the external range. Now on the hourly time frame, we'll see the same fractal. Here, clearly see a week long built up accumulation with a move inside the daily fair value gap, sweeping the previous highs here and giving a bearish structure shift. The price starts to break down from there, respecting each down close candles as we can see here, and moving towards the external range liquidity with good volume. We can clearly identify this ranging phase. This will be our accumulation here. And here we can see a clear manipulation with a sweep above the highs, followed by a distribution leg. Note that here how higher time frame arrays have worked coherently in the intermediate time frame fractal. For our next example, we take on the NAS 100 CFD. As we can clearly see, we have swept lows inside the bullish daily order block here, giving us a clear higher time frame bias. We want to see price pushing towards the external range liquidity highs here. On the daily, we can clearly see that the price has been ranging for over 2 weeks now, and this particular candle here acts as the manipulation candle after this accumulation phase. This example will show us how we can use AMD model to trade a higher time frame bias as well as form higher time frame biases. As we jump on the hourly, we see that we have flipped a 4-hour bearish fair value gap, creating a balanced price range that was left behind, and we have left behind a 4-hour fair value gap as well. We can see price sweeps the low inside the 4-hour bullish fair value gap here, and on the 5 minutes, if we go down, we see a simple sweep of the lows giving a structure shift and taking the entry off of this small fair value gap, overlapping with a 5-minute order block here, aiming for simple 1:2 hour. Here is an example of one of the trades I took a few weeks ago in February itself. We are looking at the gold chart on the 4-hour time frame. Here we can clearly see that the price has been accumulating for a few days inside a 4-hour order block, overlapping with a 1-hour bullish order block as well. A sweep of these lows right inside the 4-hour order block acts as a manipulation in the given accumulation phase that we saw. Now going down to the 15-minute time frame, we can see the accumulation and manipulation phases even more clearly, and we can identify the shift in structure and the order flow to the bullish direction here. After we see this shift here, we can see all the bullish arrays are being formed and all the down close candles are being respected, and price continues to clear to create a bullish market structure with higher highs and higher lows marching towards our drawn liquidity here. To have a clearer view of the trade I took and get an idea of how we can form trades as well using the AMD model, we see here I entered off of this 15-minute fair value gap, overlapping with an order block here, and held on to the trade till the price followed the structure beautifully towards our external range highs. I closed this trade around here at 1.5 hour instead of waiting for the range to be taken, as it was a Friday and I didn't want to carry the trade across the weekend. But as we can see, the plan was clearly followed by the market. In all our examples, we have demonstrated the AMD model as well as its application in the multiple situations, such as being used to understand the higher time frame bias as on the NAS 100 chart, to have an understanding of how the price will move towards our higher time frame draw on liquidity on our intermediate time frame chart, and use the AMD model to take entries in our pre-existing higher time frame ideas. So that's all for today. That's all for today's concept video, and I will again in this video the same old boring thing, that just keep on believing in the process and let time do the heavy lifting. If you have gained some alpha or any important concepts from this video, please make sure to like and subscribe. Leave your suggestions down in the comment and tell me on which comment should I make a video next. Make sure to join my Discord and check out all my socials mentioned in the bio to constantly stay updated with my content. And till then, stay safe, happy trading. Bye bye.